when we start to get around this time in the market cycle, which is the market was down for like a year and now we're back up almost to it, I start to get the same question, which is I invested X number of years ago. I've done nothing but either go down or catch back up. I've seen nothing but heartache for my investments. Should I take my money out and cut my losses? I'm Mike from Canavan Wealth. This is my November Ask Mike. If you would like to submit questions to this, you can send those to mike@canavanwealth.com, or there's a form on the website at canavanwealth.com. So to people who have experience in the investing, you don't even need to be an investment professional like me. You can just have invested for 10 years or so, seen the movements of the market. The idea of waiting through a 2-year flat or down market and then getting out seems crazy, ludicrous. However, it's not. And the first chapter in this book, which I often point out to people, by the way, Psychology of Money, absolutely fantastic book. The first chapter is called No One's Crazy. And they're not, right? So this chapter explains to people that everyone has a different experience and upbringing around money. And because of that, we all act differently with our money. And, people that are comfortable with investments understand money one way. People who don't have a lot of experience with investments see it the other way. So the response to people that have recently gotten into investments and have seen nothing but like a down market or a flat market, they don't understand, right? I'm 2 years into this. I have nothing to show for it, especially now when there are 5% CDs out there. Why wouldn't I get out and stick my money in a 5% CD? You were telling me average annualized returns on an investment like this might be around 7.5% anyways. I don't want to see any volatility compared to that. Now, there's a big conversation about how long 5% CDs are going to stick around. But my response to them is another chapter in this book, which is nothing is free. And what he really talks about in that chapter is that although you can get access to high quality investments for virtually free these days, right? There are lots of investments out there, index-based things that have very low expense ratios that are pretty much free. However, nothing is free. The cost of good long-term investment returns is the down years. And you can read the rest of the book to understand why you can't and shouldn't try to dodge downturns. And thus, this is the cost we pay to eventually get long-term returns. Often an excuse I hear during this is, well, at my age, I can't deal with a downturn. Often from like 65-year-olds who are going to be retiring. Well, you can watch other videos on my channel. You understand you're probably going to be in a 25 to 30-year retirement. And thus your investment time frame at 25 years is really not that different than a very young person who has a 65-year investment time frame, just when you start looking at the kind of the math and how investments work. So you have to be pretty darn old to have the opinion. And then often, you have like an 85-year-old that has $1 million and they say, well, at my age, I say, well, how much of this $1 million are you going to spend before you die? And the answer is typically zero, right? It's just there for a rainy day if I need it for end of life costs or something along those lines. Their investment horizon is effectively whoever it's going to get to, right? It's going to be their kids that inherit it or something like that. So don't use age as an excuse to make poor decisions around investments. But anyways, getting back to, kind of paying this cost and why that is important, there is a big caveat to it. And that is we are 2 years into what, is about to be a flat market, depending on how the market is. But if you invested kind of end of 2021, early 2022, you're probably close to back where you were. And that does not guarantee that next year is going to be a good market. It seems really unsettling, but we are 2 years into a flat market, but we don't know if we're 2 of 2 and it's about to be over, or we're 2 of 5. We are in the middle of some type of a lost decade or something like that, where the market really doesn't do much for several years, right? And you can look at this in the, from 98 to 2008, the famous lost decade where the stock market really didn't do much. But then look at what it did afterwards, or look what it did before it. So it's all about experience. And unfortunately for many people, they get scared out of the market before they get that experience, which is why good financial advice is so important these days. I wish I had a better answer for people who feel like they've gotten nothing out of the stock market for the last two years. All I can do is tell you the unpopular truth, which is this is just part of investing. Doesn't sell a lot of YouTube videos, doesn't sell a lot of books, although this book sold lots and lots of copies and he tells you all through it. The truth of investing is unpopular, which is we might be in 2 of a 5-year flat market. And the only real option, in my opinion, is waiting through it. And eventually the good returns will come. But that's just my opinion. I hope this has been informative. I'll talk to you soon. Thank you.